we are going to start a special roundtable discussion, and it all started with an article that Julius de Kempenaer wrote in his blog, his RRG Charts blog, and it was titled Market Analysis and Portfolio Construction Are Two Completely Different Animals in the Same Zoo. And I know, Julius, you had a question from one of your readers that kind of triggered the whole idea about this article. But why don't you just take a couple minutes and explain the question that came up and your process of going through this, and maybe a little bit about the difference between the two, and then we'll get into a lively discussion.
Yeah. Well, the reason that this came up is because, first of all, I like the interaction with readers. I don't like writing articles without knowing that they actually are interesting for people. So I always encourage people to respond or send me an email or communicate in whatever format. And I try to keep my response rate pretty high. Now, previous to this one, I wrote an article on Coca-Cola and McDonald's. These were stocks that caught my attention in the Dow Jones Industrials. And on that article, the question came from someone asking, would you suggest to own the entire ETF of a leading sector like XLP, individual high-performing stocks within the ETF like KO, or both the XLP stocks within it like KO and KJC? And that came in discuss. So I sat down to respond to that question. But after, 15 minutes, I was like halfway through a complete article explaining what I was doing. I thought, this is crazy. Let me just make this into an article. And that's what happened. And the reason why I wanted to make it an article is because I think that it is something that a lot of people not really think about. Everybody does it, in one way or another. If you're investing, you are taking these decisions and thinking about it and acting on it, maybe even unconsciously. And I think this subject deserves a little bit more attention than it might get from us as a group of investors usually. And I had to think about when I was working as a portfolio manager on the buy side at an institution, and I realized when I was writing that answer that analysts and portfolio managers are separate roles. Analysts analyze, they look at the market, they come up with ideas, they present them to the portfolio managers, and then it's basically out of the hands of the analyst. It goes into the hands of the portfolio manager, and he takes a look at the analysis, and he gathers and aggregates analysis, looks at it, makes up his mind, looks at his portfolio, looks at the mandate of his portfolio. What am I doing here? If you're a private investor, it could be your 401k, it could be a speculative portfolio, it can be anything. If you're a professional PM, you might be running an asset allocation fund. You may be running a fund that needs to beat the S&P 500, or you are running a technology fund that needs to beat the technology index, XLK. There's all kinds of different portfolios. So that same piece of research can impact different portfolio managers in a different way. The portfolios can have different restrictions. So that triggered me to think it's actually a different thought process. People think about different things. These PMs think about different things to implement that view of the analyst into that portfolio. And that is what I tried to explain, and I tried to give a little bit of guidance and a couple of things that I try to do, also touching upon the various risk parameters that you will get from different implementations. One implementation is a little bit more risky than another one. So that's a little bit of the background of the article and how it came to life and why we were talking about it right now.
All right. Well, Julius, I know you said that you were a portfolio manager.
Yes.
Did you do both roles? I mean, did you also do the role of the doing the analysis and then also trying to figure out based on risks and so forth?
Yeah, I started out I actually started out as a portfolio manager for a life insurance company. That was a junior role. So at the time I was co-responsible for a portfolio at that time of Dutch stocks. Then I moved to what's called a buy-side analyst role, where I was an analyst for an asset manager, basically advising portfolio managers or providing research to portfolio managers that they could implement. And then I moved to the sell side, where I was a sell side analyst, where I was one of the analysts that was providing research to the street, to the PMs at the various buy side shops. So I saw like three, but the only thing I never really did was either a buy side trader or a sell side trader. That's the guy who actually implements the trade. So on the buy side, on the asset management side, you got the analyst, you got the PM. And then when the PM has made up his mind and he says, I'm going to buy 3 million shares of Microsoft and 2 million shares of Amazon, then that trade goes to the trader, whose responsibility then is to execute that trade in the market, using whatever algorithm or block trades or dark pools or whatever there is. And all these rules are actually full-time jobs. That's why they're separated and really busy jobs.
All right, well, let's get into the meat of the article. I want to get into that question that you had from the viewer or your reader who asked about, an ETF. If we just talk about, say, consumer staples, the XLP, of course, that is an ETF that holds a basket of stocks, some of which may be performing very well, some of which may not be performing very well. So the question, I think, is pretty interesting. Would you consider buying just individual strong performing stocks within the ETF, or would you buy both? Would you buy the ETF and some additional stocks? And after you answer that question, I'd like to see what Erin has to say about that as well.
Yeah, there are, for me, the answer to that question comes down to the risk appetite of the owner of the portfolio. The very short and simple answer is, if you are risk averse, you don't like to take a little bit of extra risk, then you just buy the ETF, because that gives you exposure to the whole sector in the weightings that sector holds. So you're not hurt by individual stock risk. You can have XLP. If one of the stocks in XLP drops rapidly, then you will not get hurt that bad. I'm sorry. If you like a little bit more risk, then you can go to get like 3 or 5 individual stocks and make up your own portfolio.
So would you then do your own allocation, like within the consumer staples? We talked about this a little bit before the show started. The XLP obviously is weighted a certain percentage to a number of stocks. And I know we talked about, you could change that weighting. And we discussed a little bit a spreadsheet that you had kind of put together. I don't know if you can share that, but before, maybe just think about that for a minute. And I'd like to get Erin's thoughts on the idea of, instead of trading an ETF, how about just trading some of the stocks within the ETF? What do you think, Erin?
Well, I think a lot of people don't realize, and I know we've talked about it before, but a lot of these sectors, these ETFs are made up of, the majority of them are like 3 or 4 holdings. I mean, you do get exposure all the way through, but the problem is a lot of times you're already getting stuck into, buying like the top 3, top 4 just by buying that particular sector. One of the things that I consider if I'm going to do, try and spread my risk within a sector is, a lot of times I'll just go into an equal weight, because then you're really getting that exposure equally among all of the participants, and you're not kind of stuck with like the top 3, top 4 taking up your entire portfolio. I think that if you're really pro that sector, then that certainly could be good. It might perform a little better. But what we found at Decision Point is that the equal weights tend to perform better moving up, but they do take the hit harder on the way down. So it's just something you have to think about.
And I would just add, my preference when I look at ETFs, I'm not against ETFs. And I honestly think that if someone is not following the market closely, I think you're better off investing for the long term in these various ETFs and just kind of going through and probably doing some sort of a redistribution every once in a while as they kind of get away from you to the up. Some become overweighted in your portfolio, others become underweighted. So I think it's a good idea. But for me, because I'm so active in the market, I actually don't like ETFs. And I'll give you an example. if you look at something like the SMH, which is an ETF that tracks the semiconductors, you have to understand that significant weighting, like you mentioned, Erin. You've got Intel, which has been a laggard, and that is one of the top stocks in that ETF. So when you buy the SMH and you think, oh, semiconductors had a great day today, I'm in the SMH, this is wonderful. Well, sometimes you look and you're like, well, they didn't perform as well as I thought they should have. And the big reason is that you've got stocks that are very heavy weighted within that ETF, and they just don't look good to me on a relative basis. So I don't want to put money into an ETF thinking that I'm doing this wonderful allocation, and at the same time, I'm kind of throwing my money down a rat hole because I'm chasing stocks within the ETF that have been underperformers. But why don't you go ahead and take it away, Julius? Some of the things we talked about earlier.
Yeah, it's funny that you say that, because you're more of a risk taker, because the single stocks, the single stocks that you look at, they can get really hurt. If one of your holdings gets some sort of, I don't know, news thing or get hit with supply, then your portfolio will get a real serious dent, because it's a massive holding in that sector. If you own the ETF, then it's only a percentage of a percentage. Let me indeed grab the screen and show you what I created for that. Where's my spreadsheet? Here's my spreadsheet. Yeah, what I did is, because the example came from the staples sector, and what I wanted to do is make clear for everybody what it actually is, what you're looking at. So what I did is I downloaded all the individual holdings for the XLP sector. This comes from the spdrs.com website, so it's freely available. Everybody can go there. You will get a sheet that looks like this. You got the names, you got the ticker, you got the weight, you got the subsector, and you got the shares held in the ETF. Well, I don't need these sectors and I don't need these shares held, so I cleaned up that sheet and created this. Now, what I added is, if we have $1 million portfolio, the staples sector is about 7.5% of the S&P 500. So inside the S&P 500, XLP is worth 75,000 US. If we then go down into the breakdown into the individual stocks in that sector, then we'll see that Procter & Gamble is the highest weight at 15.25%. In monetary value, in US dollars, that means almost $11,500. The price of Procter & Gamble is 111. So the number of shares, individual shares in Procter & Gamble that you actually own when you buy that ETF is 103 shares. That's what it is. And it goes all the way down to the least weight. This line we can forget. I stop here at COTY. We own 15 shares of COTY, and that's worth $13. So the lowest weight is $13 out of our 1 million, and the highest weight, sorry, that's not right, $194 out of 1 million versus 11,500. So there's big differences there. Now, when I want to do some money management, I can play at a few levels. If I say I like the staples sector as it is right now, I can come in at the high level and just change this 7.5% in, let's say, 10%, which means that I'm overweighting that sector by almost 30%. 2.5% of 7.5 is almost 30%. So this is a heavy overweight, which means that instead of 75,000, I need to invest 100,000. If I buy the ETF, it means that I just have to buy 10% of my portfolio in that XLP ETF. Don't worry, and it translates in these number of individual shares. I can also say, all right, I like the staples sector, but I'm going to put some extra emphasis on a few individual stocks. So here is a little bit of mixing single stocks with ETF. And what I did here is these last three columns is the weight in my portfolio, the number of shares that it translates into, and the value of that piece of my portfolio. So let's say that I really like Coca-Cola. Market weight for Coca-Cola is 10.9%, 10.86. Let's say that I want to make that 12.5%. Then I messed this up. Sorry. This needs to be equal. Oh my God. This needs to be the portfolio weight. So 15% equals 15% times this money times divided by 100, because it's, so there you go. No, I'm doing this wrong, guys. This is a little bit messed up. Sorry, but I hope you get the idea that this translates into a number of new shares and a new value in my portfolio. And what I can then do is I can calculate the difference between the number of shares that's in the ETF and the number of shares that I need to have for my overweight. And I can then build my portfolio by buying the ETF and add like 20, 30, 40 shares of Coca-Cola or Walgreens or Kraft, etc., etc., and construct my portfolio in that way, keeping a big allocation to the sector through the ETF, and put my little spots, my little extra additional risk in individual stocks without getting hurt if something happens drastically.
All right. Now, this is just obviously consumer staples. So
yes.
So you would go through this process in every sector?
Well, that's the thing you said. You said about a work and active. I think that one of the also, because our audience is primarily retail investors that probably work normal day jobs or whatever. They have a life. They're not in front of a screen all day and not watching the markets all day. So depending on how much time and effort you can afford to spend in the markets, you can play around with that. If you are a weekend investor, or you don't have a lot of time, or you don't want to spend a lot of time, you can create a portfolio just using ETFs. You can go to a little bit of a higher level, put up your portfolio, put all the ETFs there, figure out what the weights are, and then say, okay, I really like staples, utilities, financials, etc. Put money there and calculate how much shares of each sector you need to do, and just let it go. And maybe put one or two, little emphasis, little notches there. Whereas if you're very active, as you are, you can just skip that whole ETF bit and go to individual shares and run your portfolio there. I will always recommend people to keep an eye on what those individual shareholdings on an aggregate level mean towards a sector. Because, I don't know, let's say that you're trading individual stocks, your portfolio maybe has 20 to 30 names in it, roughly. If out of these 30 names, 25 are from the technology sector, your risk is probably a little bit skewed to the technology sector, and you should be aware of that. So even if you trade individual stocks, I'd always recommend keeping an eye on your sector allocations and make sure that they're not too far out of whack. Well, I mean, I don't want to go into your position, but for me, that would be too high risk, because it means that if some news comes out, if something happens to the technology sector, your whole portfolio will get a dent.
All right, I'm going to follow up on that for a second, because, and by the way, I'm guilty as charged. I am a risky trader. I've been called that before, but I think it's done with a lot of technical analysis behind it. And I am a momentum trader. For those of you who are new to the show, I'm very much a momentum trader. So I tend to stick with what's working until it's not. But Warren Buffett famously said that diversification is a protection against ignorance. And I know what a lot of us do here and what you've been showing, Julius, it makes sense. But there's also, I mean, when you look at the mutual fund industry, there are estimates that about 80% of mutual funds underperform the S&P 500. So either they're not doing the market analysis, that you talked about and constructing a portfolio properly, or maybe their expenses are too high. But, that's the choice that most people have to make, either to construct their own portfolio or to go with others who are putting together portfolios that are not able to keep up with the benchmark. So I like the idea of taking the best stocks within the sectors. And I would say you don't even need to be limited by the ones that are included in the ETF. So in the XLP, Joyce, you just listed all these individual stocks. There's obviously a lot of other consumer staple stocks that are not in that particular ETF and provide some opportunities. But I wanted to see if Erin would chime in. Just any general comments you have, Erin, about diversification, about being in ETFs versus individual stocks and so forth. I mean, do you have any thoughts to add there?
Well, I mean, I obviously am a little bit lower risk than you, Tom. Typically, my time horizon is such. So I get your point about, having the underperformance a lot of times from these sector funds. But, at the same time, your risk level is not the same. So you may not get that, big payoff at the end. But you're taking on more risk, and I think, Julius, you mentioned it in your article, and we were just talking about it. If you're not going to be glued to your computer screen, if you're not able to really watch your short-term investments or your allocation that way, I mean, I do invest in some of the ETFs. I do like to go into the equal weights myself, just because of the fact that it is weighted the way it is, and I get pretty much equal exposure across all of the components. But really, that's my thing is, I think your time horizon, what I also suggest to people that I do is, have different accounts with different time horizons in mind. Your buy and hold portfolio, your swing trading portfolio, your really short-term portfolio. But those are the things you have to consider. I mean, you may get better performance, but you have to be able to watch. I mean, that's ultimately it, right?
Yeah, it takes time.
Yeah, I'm gonna share a chart with everybody, and then Julius, you can feel free to take it back. But this is a chart of a different sector. We were talking about consumer staples, but this is the energy group. And this is energy relative to the S&P 500. And there are a number of factors that go into this. But of course, the rising dollar that we've seen the last 8 years has certainly played a part in the fact that energy has been underperforming the S&P 500 for a while. Now, in constructing a portfolio, and I am not a portfolio manager, never been one, never had to manage money for a wide number of people and so forth. So there's definitely an element of risk that you have to take into account when you're managing money for others that you don't have to take into account necessarily when you manage your own. Because, at the end of the day, it's you've got what however you invested and however things turned out. But when I look at an area like this, energy, I don't want to invest in an area like this. And I know, you go through periods. We could point back to 2016 where we had outperformance in energy. You can look at this pop in 2018 where we had a move to the upside. This is a relative chart. Again, this is not an absolute chart. So this is just simply telling us how energy is performing relative to the S&P 500. If I take out the S&P and I just simply pull up an energy chart, you'll see that we actually, during this period, we had some pretty good periods moving higher, but we didn't do it, or we didn't outperform the S&P 500. So I think when you construct a portfolio, and I know you wrote about this in your article, Julius, you have to decide what your goals are.
Of course.
And if your goal is to outperform the S&P 500, looking at that chart that I just showed you on a relative basis, the money that you invest into the energy group is going to be an area, it's going to be hard to outperform if you simply stick with the percentages of energy in the S&P 500. So,
but hang on a second. You can be pretty aggressive with ETFs. I mean, that's the analysis part. So if the analysis part, and I 100% agree with you here that I don't like energy either. So in a portfolio only using ETFs, I can perfectly see 0 holdings in energy.
Okay.
So out of these 11, you don't have to. It's like we're not like professional PMs that can deviate like only like marginal basis points from the market weight. We can actually make a dent. So what's energy in the S&P 500? It's not a big one, but it's like maybe also 8 or 10%, probably like that. Yeah. Chop that off. Just 0 holdings in energy, and you have 10% of your money that you can spread out over a couple of sectors that you do like. So I can see for a private investor a portfolio with its own goal of beating the S&P 500 with maybe 4 or 5 holdings. So you just pick 5 sectors in the S&P that you really like, and you stick your money in there, and you can do that as Erin said, equal weight. So you can put 20% of your money in each of these ETFs, or you can do that pro rata for these 5 sectors. What's left? It's a simple calculation. I mean, you can put that all in spreadsheets and make it work for you. What I was trying to explain is that when you buy an ETF, you actually buy a whole basket of stocks, and you actually own, as I said, 7 shares of COTY or 110 shares of Procter & Gamble. If we decide that we don't like staples, we own 0, because at the top line, we just have 0 allocation to staples, which means that it trickles down. We have 0 allocation to these individual stocks. So, I mean, that's the point that I'm trying to make, that it's a versatile process. You got a lot of options. You got a ton of options, actually. And I feel that a lot of people are not aware of the options that are available to them to actually play around with these numbers, mitigate their risks that they might be running that they're not aware of.
Mm-hmm. I've got the cap weights here on the screen.
Right. So energy, this is 5%.
Yeah, 5%. Yeah. Of course, it's the only one on sell signals too.
Yeah. So if we look at this, we don't like energy, so we chop off 5% there. We like staples, so we put staples. We put 5% in staples, which means that staples goes from 7.5 to 12.5. There you are. So then, without a lot of work, but with a little bit of analysis, we now have a portfolio which is heavily underweight energy, 0, and overweight staples, and the rest is market weight. So there you go. There you have a very well spread, balanced, diversified portfolio in the S&P 500 with a bet built in that we like staples and we don't like energy. Mm-hmm. And you can actually do that. So I actually got my my spreadsheet back up and running. I thank God for Control-Z, where you can actually go back.
Go ahead and share it.
Yeah, so I'm going to quickly share it with you. What I have here is the same 1 million, and what I just did while we were talking is upped the percentages for the top 3 shares to 15%. So 15. So I'm overweight Coca-Cola and PepsiCo, and what the sheet does, it calculates how many extra shares you need to buy of Coca-Cola and PepsiCo. So 75,000 is 7.5%. If I put those two at 15%, my total weight goes to 8.14 because I'm now overweight more than 100%, which means that I buy XLP and I need to buy 60 extra shares of Coca-Cola and 26 shares of PepsiCo, and then I've got the whole sector with emphasis on Coca-Cola and PepsiCo. By the way, people who like this sheet, I just literally put this together in 15 minutes. I'm happy to share it, but I'm sure you guys can actually put it together yourselves if you want to. If you need it from me, just send me a message and I'll be happy to share it.
All right. Well, we're going to go ahead and wrap up. It's a fun, very fun segment, though, and I really appreciate you joining us, Julius.
No problem.